We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of SRSrocco Report.com. How are you today, Steve?
I'm doing great, Tom. And it's great to be here. We see some interesting things happening in the market, so there's plenty to talk about.
Absolutely. You and I have a lot to get to here today. So I'd like to start by really kind of fleshing out your thesis here. And let's start talking about how you really believe that energy comes first. Gold and silver, as you see it, are energy stores of value. Things like fiat, real estate, stocks, bonds, they're all energy IOUs. So let's start there by looking at it through that lens.
Yeah, Tom, thanks. And I think this is the crux of my analysis. And you don't have an economy unless you burn energy. And it used to be human and animal labor. That was the most energy of the economy for thousands of years. Then we started burning wood and coal. Now it's oil, natural gas, other energy sources such as nuclear and wind and solar, et cetera. And the thing is, we take it for granted now. Back years ago, when people would have to do their own farming by hand, either with hand tools or when they use a horse or an oxen, you knew the energy it took to harvest and plow that whole field. It was a lot of energy. Now you just get in a tractor, you turn on the switch and you've got satellite tracking and you're in this huge combine. You know how much fuel you're using, but you really don't have any idea. And so I think that's the problem. The energy has to be burned to have an economy. And for thousands of years, gold and silver have been money because they have stored the energy equivalent of the local area, of the community, of the region, or the empire. And so when you understand that, that's what made gold and silver money. Unfortunately, a lot of analysts in our industry don't explain it that way. We look at gold as a hedge against inflation, or gold is a hedge against the collapse of currencies, and that is true. But really, it's been this energy store of energy value. And so the problem now when we look at real estate and fiat money and bonds, they get their value. They have very high values because they're based upon what's going to happen next year or in 5 years. Because most people, when they get a mortgage, Tom, it's a 20-year, 30-year mortgage. Well, it's going to take 20, 30 years of burning energy, producing economic activity to give you the profit to pay back that mortgage. So all these things are based on energy IOUs. So that I look at the metals, gold and silver, as being the top assets to own because the world now is facing a dire energy predicament. I call it the energy cliff. And when you understand that, that's why it's so important to be in the precious metals. And we're starting to get a whiff of that now since the pandemic.
Absolutely, Steve. So you talk about GDP growth as a function of oil production. So let's talk about the US accounting for 75% of the world's GDP growth. But when they start running into trouble with the depletion of their unconventional oil, like their shale oil production, as you're saying, that's the energy cliff, as you're calling it. So let's link that to the coming depression instead of the rosy future ahead that people think that technology will be able to solve every problem that arises.
Yeah, Tom, I put out a new video on my YouTube channel. It's called The Important Video of the Energy Cliff and Why We're Going to Head into a Depression That Never Ends. And I'm not just saying that because that's my opinion. It's just looking at the information. So when you go to a family function, whether it's Thanksgiving or Christmas, or you see people at work or whatever, and you ask them about the future, they're going to say, well, gosh, Tom, look at technology's done in the last 20, 30 years now. What do you think it's going to be like in the next 20, 30 years? That's the knee-jerk reaction. Well, let me tell you, technology isn't energy. Technology is a massive consumer of energy. And the more advanced the technology is, the more energy it consumes. So when you think that's the future, I don't believe in that future. Unfortunately, I believe we're going to head more towards the energy cliff, which means less energy. When there's less energy, there's falling GDP because GDP is tied to energy growth, mostly oil growth. And so when you have falling oil production, you have falling GDP. And so then you have less people working, and it's a very bad feedback loop. And so that's how I look at it. And what has propped up this economy since the Fed and central banks lowered interest rates to zero after the 2008-9 financial crisis, what has brought us out of that crisis? It wasn't the zero interest rates. That was just the steering of the car. What did it was the shale oil and oil sands production, which exploded over the last 12 years. And so you need the energy, because I don't know if you've been in a car and the engine's off, try moving that steering wheel. You're not going to go anywhere. So if you don't have the energy in that car, it doesn't do anything. It doesn't matter if you want to steer it. And so we'll try getting that car and pushing it for a mile. And that's how much energy is in a gallon of gasoline. So I think that's the problem we're facing, Tom, where the world was propped up over the last 10, 12 years to this very high cost, unprofitable, unsustainable, unconventional oil. And now we're getting ready to see the hangover as U.S. shale oil production really starts to collapse over the next 5 to 10 years.
Mm-hmm. I think another important point to kind of highlight there, as you're saying the technology won't necessarily solve all these problems, is that without energy to power that technology or to power that GDP growth, there is no solutions that can be built off of that. So, Steve, let's talk a little bit about the EROI, or the energy return on investment, and how the US shale oil industry and the cheap money that supplied it is kind of a vicious circle.
Yes, the shale oil industry was made possible due to the zero interest rates. And so because shale oil wasn't profitable, it needed a lot of investment. And the only way that worked was very low interest rates, because they could not fund a business as usual at high interest rates. Their interest expense would have been, prohibitive. So we had to have the zero interest rate. And so the unfortunate thing is the shale industry bonanza was a one-time boom and bust, kind of like the gold rush in the 1800s in California. It was a boom and a bust. And so that's what we had with the shale industry. And now, unfortunately, as production starts to decline, it makes the situation worse, not only for the shale oil industry, but for the United States, because now the U.S. has to start importing more oil. And that's going to negatively impact the dollar. And with our debt to GDP being so high the way it is now, Tom, there's too much against the U.S. economy, the U.S. balance sheet now. I'm not saying it's going to fall apart tomorrow, but it just gets worse as the situation in the shale industry starts to unravel.
And again, I think another important point to kind of highlight there is that the shale oil industry necessarily wasn't sustainable at prices where oil is now, right? And that's why that cheap money and those low interest rates prop that industry up, is because they weren't necessarily making money, or they're not able to function as a company with anything less than, let's say, $100 barrel per oil, right?
Well, what's interesting about that dynamic, when the price of oil went to $100 for 2011, 12, 13, and partially 14, the oil industry didn't make any money. The shale oil industry didn't make any money. Do you know why? Because the price of pipe goes up. The price to transport the fracking sand goes up. The price of water goes up. And they use a lot of this to frack a typical shale oil and gas well. So in the beginning, when the price of oil went up, there was a bit of a profit there for a very brief period, but then all the costs go up. Mm-hmm. And due to the problem that it's such a low energy return on investment for shale oil, tight oil, very quickly, as the energy price goes up, like the oil price, then it thunders through the entire supply chain and everything goes up. And so it's really not profitable at high oil prices. And so that's kind of the double-edged sword. But the worst thing now is also this low price is not really good for conventional, because a lot of the conventional that we were tapped into now is a higher cost. And so at 40, it makes a lot of conventional oil not profitable. Forget the shale oil. And so this is part of the issue that we're seeing right now taking place in the U.S. industry as well as globally.
Mm-hmm. So, Steve, let us know some of the, let's say, the stats on this energy return on investment, and kind of highlight that to give our audience a bit more of a concept of what we're talking about how much oil we're actually expending to be able to be getting this shale oil out of the ground.
Well, there's been a lot of analysis, and if anything, some people don't have agree with the number. But if we go back into the 1930s, if we include the finding oil discovery, and if we also include the drilling and production of oil, U.S. was doing 100 barrels of oil for the cost of one barrel. And that's energy, not dollars. You could say dollars, but so that's 100 to 1. Mm-hmm. And so 99 barrels made it to the market. But by 1970, Tom, it fell to 30 to 1. And at the beginning of the 2000, it was like 11 to 1. And then now shale oil, they say it's about 5 to 1. Oil sands is about 4 to 1. And so now, yeah, we're producing a lot of shale, we're producing a lot of oil sands, but the minimum number that it takes to run a modern society, the oil energy return on investment, is about 10 to 12 to 1. So that's the problem now. It doesn't matter if you've got 10 trillion barrels of oil shale, which is even worse than shale oil. The Shell and Chevron, they all gave up their oil shale operations in the western part of the U.S. several years ago because it wasn't even profitable, not even at high oil prices, because the energy return on investment of oil shale is like less than 2 to 1. So just to maintain the infrastructure of the interstate highway system, according to Charles Hall, who's one of the leading minds on the energy return on investment, just to have the roads and the highways, you need a 3 to 1 energy return on investment from oil. And that's it. That's all you could do is drive around on the interstate. Now, if you want to add hospitals and business and homes and all that, then you need a higher energy return on investment. And right now, tight oil is around 5 to 1 energy return on investment. And I believe that was the first oil they tapped into. They tapped into the better quality, higher tight oil reserves. Now they're getting into the lower quality. And so I think the energy return on investment is actually lower. So this is the dynamic that's playing out right now.
Mm-hmm. As you say, it's lower quality and it's probably harder to get to. And you have to spend more energy to be able to A, get to it, and B, refine it, make it economical. So one of the things that you and I were talking about before we started recording was the percentage of the world's energy that is produced by oil, natural gas, and coal. And we'll address some things as a part of that as well.
Sure. You see, we're going to run into trouble with fossil fuels. Mm-hmm. Let's forget the climate issue, the idea of moving into green energy because of the fossil fuels. I agree with that. Some people don't. And let's just forget that then. There is no climate issue. Everything's fine. We're going to have a problem with fossil fuels.
And this is, let's say, peak oil, right?
Yes, there's two things happening. There's actual production that will peak, just like anything else. And I think I mentioned in one of my videos that the world is consuming 4 barrels of oil for every barrel it finds. So that's 4 to 1. Now, you could do that for quite a while if you have a pretty good bank account of oil that you discovered in the past, but we're not replacing it. So that's going to impact us sooner or later. And we've tried to make it up with shale, but that's not a long-term sustainable business model. That's a boom and a bust. And so unfortunately, now when the world is consuming about 88%, it's about 88% fossil fuels, which is oil, natural gas, and coal, that renewables are never going to be able to be scaled up. And the problem is it's all down to the oil, Tom, because look at Venezuela. When Venezuela's oil production has fallen considerably over the last 5 to 8 years, so is its electricity production. It goes hand in hand. And so this is the issue. To get the coal to power coal-fired plants, you need to use diesel equipment, whether it's extracting it, transporting it by rail, barge, or truck. It's the same thing with natural gas. A lot of these natural gas wells, I mean, they're drilled by using thousands and thousands of trucks, all powered by oil, diesel. And so oil is the most important energy source that allows other sources of energy. And so when you understand we're going to start running into trouble, we're going to have peak oil, but that's not including the net energy that's drastically declining. And that's the reason why we're seeing all this debt. The debt is being used to offset this falling energy return on investment. And so now we're trying to get into green energy. Even if we wanted to do it, we're not going to have the oil and natural gas and coal to do it. And unfortunately, we're not going to have the available fuels to do that, even if we wanted to.
To be able to produce all of the, let's say, power generation units, solar panels, windmills, et cetera, to be able to try and set us up for that, right?
Yeah. And again, it's kind of like a conveyor belt. There's an old Lucille Ball show, the Lucy Arnaz show, where she was baking these cakes and had to put them in boxes. And after a while, they were getting backed up and they were falling off. Well, when you build a new wind turbine farm, it's got about a 15-year life expectancy. It's not 25, 30 years. It's about 15. That's what it really is. Well, in 15 years, you got to replace all that. So you get 15 years out of it, but then it's got to be replaced. Well, these wind turbines are not made from Star Trek replicators. They're made by mining the metals, by mining the materials, transporting the materials to manufacturing plants, making all the components. There's thousands of components, and they all have to be transported again to assembly plants. And then they have to be transported. The wind turbine blades are now, they're huge. They have to be transported by a big tractor trailer, and there's 3 of them. And it's all fossil fuel. So you can't offset a decline in fossil fuels with wind and solar. Actually, they don't solve the problem, Tom. They make the situation worse. A lot of the green energy movement doesn't understand that. If it made the situation better, I'd say, okay, let's give it a try. It doesn't. It makes it worse.
Because we're using so much oil to produce those things in the first place, right?
Yeah, basically they're fossil fuel derivatives. And if you take into account the intermittency issue, because the sun doesn't shine all the time and the wind doesn't blow. The problem is it's okay if you add 5 or 10% of wind to the grid or to the area. But when you start saying, okay, we're going to do 25 and 40% and 60%, well, what happens when the wind stops blowing? Mm-hmm. You now have 50% of your electricity coming from wind, and in 1 minute, it's all gone. That was okay when it was 10%, because then you had natural gas balancing power to come online to make up for that loss. Mm-hmm. But when you increase the solar and wind so much, you're going to see the same problems that are happening in Germany and in Australia. The cost of electricity have gone up dramatically. And this is the issue. And you really don't save the carbon as they thought they would by going into wind and solar. It's not really doing what they wanted it to do. It's making the problem worse.
So obviously, this is a perfect spot to talk about uranium as well. And let's talk about nuclear power and what your thoughts are on that as a power generation source as well.
Back in the 50s, the funny thing about the nuclear industry was, what was their famous saying? Nuclear power is going to be too cheap to meter. Well, it took another few decades. We realized that wasn't true. So when you understand the full cycle energy return on investment of a nuclear power plant, it's too low. It's too complex. And then there's all the spent fuel, all the radioactive spent fuel that we don't know what to do with. And it just gets larger and larger. The problem is with uranium, it cannot offset or replace fossil fuels because the lifeblood is oil. And we started seeing the breakdown in the supply chains during the pandemic. And that was due to trucks stop moving as much. And so what happens is there are no uranium cars, nuclear cars. There are in some science fiction movies, but everything's run on fossil fuels, on oil. That's the lifeblood. That's the supply chain, the just-in-time supply chain that makes everything happen in the world today. Cannot happen with nuclear or electricity. It can only function on liquid petroleum fuels. And to transition that to electricity, it can't be done. We just don't have the energy to do that. So the problem with uranium is, and even thorium, if we really wanted to do some of these things, they wouldn't have worked. But let's say, okay, we're going to try. We should have done it 25, 30 years ago. Now we've run out the clock. Now we're actually entering the energy cliff. And so it's too late now. And now those choices are not viable choices.
Yeah, it makes me think that, let's say if nuclear technology, if it had a chance, but simply because of public opinion, that technology has not been advanced since, the 60s, with the exception of some smaller projects now that are being researched. It makes me wonder if we would be looking at a different picture of things had we started looking at this scenario much earlier, as you were saying. So I think another interesting parallel that we can draw here, Steve, is that as you're saying, maybe we're hitting peak oil. Have we maybe hit peak gold and silver production as well? And let's talk a little bit about falling grades and deposit sizes in the gold and silver industry.
Before I get into that, I do want to make this is important. We have hit peak conventional, and that's important because a lot of people say, well, these peak oil guys, they always get it wrong. The conventional is the good stuff. All right. That's the good stuff. And now we have increased with the bad stuff, right? And so we've increased with the shale oil and the tar sands, oil sands, and in deep water, which is very expensive. And so that's not sustainable. That's not going to help us. But that kind of like let the party go on for another decade or so. So the thing is, we have peaked in conventional oil production. And when we start to peak in unconventional, then that's when people say, well, we did. Okay. And that's when we start entering the energy cliff. Now, when it comes to gold and silver, which a lot of people like to know about, is that...
Sorry, Steve, before we continue there, I would just like to kind of maybe frame it a little bit different way. As you're saying, conventional being the good stuff, we could almost think of conventional and unconventional being efficient and inefficient oil, right?
Yeah, that's probably a better way to put it. And to say inefficient, it just takes...
far more oil spent to be able to get it out of the ground.
Yeah, if you got an apple tree outside your house, it's about 5 steps from your door, and it's very small and it's very wide, and you just grab the apples and you bring them in your house and you have apple sauce, whatever, or you make apple pie. Well, now you've gone through all those apples, and now to get that apple, you got to go up 10,000 feet on top of a mountain. Of course, apples won't grow up there, but I'm just trying to say that's what you got to do now to get that apple.
Mm-hmm. That's why I was thinking about inefficient and efficient.
That's correct.
That's maybe a better way to kind of conceptualize it. So sorry to interrupt you there, Steve. Let's move to gold and silver now.
Well, it's interesting. Gold, well, except for the pandemic this year impacting the gold and silver production, gold production actually has been continuing to increase. Since 2015, that's when silver peaked. From 2015 to 2019, gold production increased from 104 million ounces to 111 million ounces. But at the same time, silver production went from 894.5 million ounces down to 836. And this year, my forecast was about 780 million ounces. That's due to the pandemic. So what we've seen, gold was not peaking. Gold was continuing to move even higher. And it may have been about 111 and a half this year if it wasn't for the pandemic. And so I think the interesting dynamic right now is that silver production did peak back in 2015. Now, will it surpass its peak? And I don't think so. I think the peak of 894 million ounces, I know there's some projects coming online, but I don't think we're going to surpass that 894 million ounces. Gold, we may see a bit more, but the peak yet for gold is still up in the air. But I would say as the energy cliff moves into high gear, it takes so much more energy to produce gold. I think we're going to see peak gold shortly within the next several years.
So in the past, Steve, we've seen metal prices closely tied to the price of oil. And as you've said before, each ounce cost of production with the energy equivalent input cost priced in. So why are we starting to see a disconnect now with oil trending lower, yet metal prices moving higher?
Well, I think the 2008-9 financial crisis and the pandemic now has really made people understand the value of gold and silver as money. And that's their store of energy equivalent value. What they've been based upon over the last, let's say, 100 years now, or at least since the 30s, 40s, they've been based more upon as a commodity, which is cost of production and supply and demand. And most things are based upon a commodity. Copper, what it costs to produce it, and then the supply and demand. And that's how you base the value of a commodity, the market value. The thing is, a lot of silver and gold are not used up. A lot more silver might be, but they're money because a lot of it is stored. And so the issue is, Tom, right now in the 1970s, we had consumer price inflation driven by oil. And that's what made gold and silver reach new highs in 1979 and 80. And then as oil price fell down, the gold and silver price went into this 2.5 decade consolidation. And then what happened? When oil went from $14 a barrel in 1998 to over $110 a barrel by 2011, well, that impacts the price to produce gold. And so the price of gold went up to $1,900. I think the average for 2011 was $1,660. And silver, the average was $35. So in the 70s and in the 2000s, the precious metal prices were based upon rising energy cost. Interesting, this last year, as you have mentioned, the oil price has been going down and the gold and silver price has been going up, which is good for the miners too, because their costs remain lower. And so I think that's the issue we're starting to see now. Even though the metals have corrected, I think we're going to see this more and more. The value of the gold and silver, there's just not much of it. It's not only based upon what it costs to produce it. It's also based upon if there's available gold and silver, and there's not that much more silver. So as this energy cliff starts to get worse and worse, more people, I believe, are going to move into the metals to protect their wealth. And then we're going to see much higher valuations, and it won't be based upon what it costs to mine them.
So Steve, as you kind of alluded to there, there's a couple of reasons for why you say the next bull market in the metals will be one that doesn't end. So let's kind of tie all that together through that lens of looking at it, as you say, of the next bull market being one that doesn't end.
Yes, because if we understand we're going to have problems with energy, look what happened with Venezuela. Look what happened with the Venezuela currency. It just continues to hyperinflate, right? And so someone says, well, as soon as gold gets to 10 trillion bolivars, I'm going to sell my gold. It's like, well, you're going to sell it for what, 10 trillions of the currency? And so I think the issue is as energy becomes problematic, it just makes more and more sense to own the precious metals. And I would imagine you and listeners realize it's less than 1% of people own gold and silver. So what happens if it just doubles? What does that do to the precious metal price? What if it goes to 5%? And so this is the factor which I see as energy becomes more problematic, so do the values of most stocks, bonds, and real estate. Of course, you have to live in a home. Businesses still try to function in a falling energy environment. But when you see all these commercial buildings and all these businesses, let's say in Dallas, Texas, or anywhere, New York, Chicago, or anywhere, London in the world, what happens when there's a half of the energy oil to use for transportation? There's half the amount of activity, which means half the GDP, which means all the values of the businesses and the real estate are going to decline. That's coming. The pandemic has given us a preview, especially in commercial real estate. That's going to happen on a more long-term and structural level that we're never going to recover from. And I don't know how we transition. We can't really transition out of this. It's going to be kind of like just figuring out how to live with less energy and what that's going to do. And I'll tell you, the best assets to protect your wealth are the metals.
So Steve, my thinking there, as you're mentioning that, if oil production starts to fall so much, obviously we're going to see a rise in price, right? So won't that help support the GDP, or is it just more a function of the actual production will fall regardless of price? And if you don't have the oil to be able to burn or the energy to be able to support your economy, that's going to affect everything as a, let's say, a first order effect, regardless of what the price ends up being.
What you just mentioned, this we can talk about for a half hour. And part of it has to do with the study of the thermodynamic oil collapse. Due to the value of oil falling, then what makes it to the market, there's less of it, right? So it has less value. See, what people don't get, they go, wow, it's supply and demand. The theory of economics 101 is destroyed by the thermodynamic oil collapse. It doesn't work anymore because the only way you can bid up oil, and let's say we don't talk about inflation, no money printing. Let's throw that equation out the window. Let's just say the stable dollar, stable currency. The only way you can bid up the price of oil is you have to have the profits from the oil, because the oil is what's driving the economy and what's actually creating the money if bankers aren't doing it. It's the profit from the energy that allows us to have the profits to buy the oil, to bid it up. Well, if the net energy is falling, how can you bid the price up? You can't. The only reason why it looks like it's going higher is because of inflation. So we have two different dynamics going on. The falling energy return on investment of oil, it's not worth the high price. It's like a brand new car is worth $30,000. A 15-year-old car is worth 10. You're not going to pay 30 for a 10-year-old car. All the embedded energy in all those parts have been worn down. It's not worth a brand new car. You're not going to pay top dollar for a 5 or a 10-year-old cow that you would for a 1-year-old cow that's very healthy, very vibrant. So this is the same kind of dynamic that's happening with energy. The price of it is getting screwed up due to all the money printing and inflation. So the only way we could see very high oil prices is if the Fed does get to pass its digital dollar policy and starts sending Americans, as well as other central banks, money directly in their bank account. Well, then they have money that they can go out and buy things. But then everything goes up in value. The price of bread goes up. The price of cars go up. It's not based upon the energy going up. It's based upon the printing going up. So I think the dynamic is supply and demand pricing does not function thermodynamically speaking. And unfortunately, Economics 101 is no longer a viable business model when it comes to oil, which is the leading driver of the economy. And so I think the problem we're going to face is people have to think about this. We could have $1 gasoline, but if you've got 50% unemployment, you cannot even afford $1 gasoline. It doesn't have to be the price of gasoline is $10 a gallon. It could be that it's less, but you can't even afford it because you don't have a job.
Yeah, demand will also fall.
Exactly. And so when there's less production, there's less economic activity, that's less employment. You're out of a job. You can't even buy the oil or the gasoline. And so I think this is part of the dynamic that is most misunderstood. The knee-jerk reaction is, well, if the supply falls, then the price is going to go up. No, not necessarily. Matter of fact, the thermodynamic oil collapse suggests the price is going to trend lower.
That's assuming demand stays the same or increases, right?
Yes. And the thing is, let's say I demand 10 gallons of gasoline. I demand to go in that store and put 10 gallons of gasoline in my car. The guy says, okay, give me your credit. I don't have any money. The demand might be there, but you might not be able to afford it. And I think this whole idea of supply and demand, it's interesting, but
there's several things to consider there.
Yes. And lastly, I think the issue is a lot of people maybe understand this. The oil price has to be a certain price that the consumers can afford it. When it gets too high, that then demand falls. And then there has to be a certain price for the oil companies to produce oil and not go under. And so that's the dynamic that's playing out. But as the oil production continues to fall and the energy return on investment, then it goes into the second thermodynamic pricing mode, whereas the price will continue to trend lower if we forget about the Fed printing, all the money printing, and people just won't have the money to buy it. Let's forget money. Let's say they won't have the energy to buy it, okay? If the energy production is falling, all money is energy. So if there's less energy production, there's less ability to buy it because there's less money. That's really what it comes down to. Forget the money printing. Look at it as what energy can do to produce economic activity and money. And I think that's the problem. If we could look at everything in a price tag of how much energy it took, not the dollar amount, we would understand this dynamic much better.
So, Steve, as we're talking about supply and demand, it makes me think about the physical silver demand that we've seen absolutely spike this year since, let's say, the March crash. So how will this affect price going forward into next year?
We've never seen a year like this, Tom. The most we've seen, I think, is a little more than 300 million ounces of physical bars and coins. This year, it's almost 600 million, and that's including ETF. Now, a lot of people say, well, you can't believe in ETFs. All right, fine. I don't know if all the metal's there. When I look at that ETF demand, that's retail demand and high net worth demand. A lot of demand for gold ETFs is institutional, but most silver ETF demand is retail and high net worth. That's a barometer. That means a lot of people are very concerned about what's happening and they moved into the ETF. That's the best technical indicator I get. I could care less if there's the silver in the ETF. The thing is, if we get another year like that next year, and I do believe a lot of that silver's in there. I've looked at some of the, there's like an 8,000 page JP Morgan silver bar list. Now, maybe they're fabricating all those bars, but they have a list, 8,000 plus page list of all their bars. And you could see the weights, you could see the serial number, you could see the refiner it came from. Maybe that's all manipulated. Okay, that could be, or some of it is. But if we have another year like next year, which I think we could, it's going to be very hard to access that much metal. And again, just a 2% increase. Again, we've never seen 600 million ounces. We have to remember, if mine supply is 780 million ounces, investment demand is 75% this year of mine supply. It's never been that high. You get another year like that, that's when we can start seeing crazy silver prices. And I think that's just the beginning, Tom.
So, Steve, let's contrast silver to gold and why silver seems to be so undervalued compared to gold.
Well, silver is undervalued compared to gold, let's say more recently. You see, it's due more to looking at silver as an industrial metal. And, if I hear another analyst say, well, industrial consumption is going to increase due to the green energy, I'm thinking, did you just see how much investment demand we had this year? It was 600 million ounces. Do you know how much industrial demand is? It's like 480 million. So we have surpassed industrial demand for the first time in history. My analysis suggests the value of silver, the price of silver moving forward will have less to do with industrial demand. Because if we're going to have falling energy, we're going to have less industrial demand. It's going to be investment demand. The problem right now is more institutional pulling of gold. People seem to be more focused on gold. But if we look at total investment stocks in the world, investment bullion stocks, there's maybe 2 times more silver than gold, possibly 3 bullion. If there's about 2.5 billion ounces of total gold that you can get your hands on in the world, that's central bank gold, private gold, there's about 5 billion ounces of silver, possibly 7.5 billion investment. When people actually try to access that metal, and we'll get to the futures in a minute, there's just not that much more silver. And in the past, in ancient times, they valued gold based upon its energy equivalent value. But if there was 2 or 3 times more silver in society than there was gold, that's how they valued the price. Mm-hmm. It was valued how much there was. And I think right now, silver is so undervalued because the market is still looking at it as a commodity, not as a store of value or energy equivalent value. They haven't figured that out yet.
And I think that's an interesting point you bring up there, Steve, is let's say the investment grade ratio of silver to gold. And normally we're used to hearing about, let's say, the amount of silver in the Earth's crust, which is somewhere, let's say, between 10 to 8 to 1. And that really kind of ties back into the gold to silver ratio. But I like that you brought that up, that the investment grade bullion ratio of gold to silver is actually lower than what we're used to hearing.
Yes. And because the price of gold and silver, the ratio is valued to what it costs to produce them. That's where you get that 70, 80 to 1 ratio. That's the production cost difference. It's really that simple. And so when you understand that, and back in the day when it was more 10 or 15 to 1, well, they were looking at the energy equivalent value or the cost to produce it, but it was also the ratio of the metal at the time too. That's what the value was based on. Now it's more of its cost of production.
So Steve, let's talk a little bit about the US dollar and the price of silver relationship. How do you use technicals and fundamentals together to inform your idea of where the price of the metals is heading?
There's 2 ways of looking at the metals. If you're going to wake up in the morning and you're a precious metal investor and you turn on Kitco or somebody and you look at that price throughout the day, well, then you need to understand technical analysis because the technicals are what kind of drive the price on a short term. If you don't care about that, you just say, well, I'm going to buy a certain amount of gold or silver every month. And I don't care because I'm waiting when I retire in 10, 15 years. Then you don't have to worry about the technicals. Because a lot of people say, well, they follow the precious metals. And why is it silver and gold sold off a lot today? And it's the first thing that comes out of the mouth is manipulation. It's a banker smash. And so the thing is, if you're going to look at the metals on a daily basis, then it's important to look at the technicals. And the technicals give us clues as to what the trend is going to be. And I've been writing about the breakouts. People need to understand when the price of silver and gold break out, like gold broke out last year, and then gold broke out again this year, and so did silver. They broke out at certain levels and these certain resistance levels. And when that happens, it's a spotlight. Then precious metal investors start turning on Kitco more. Traders start looking at gold and silver more. And a lot of traders, and so they all jump in. And that's when you start to see the big moves because everybody's moving in because it's exciting to move into something that's going up. That's the way not only gold and silver work, but every other stock and commodity. That's the way it happens. Well, once it gets up and then it's shot up, well, it's not going to stay up there forever. Maybe Tesla, but most stocks don't do that. And so then you have the consolidation. And so if you look at these technical levels, especially how the dollar has been in an inverse relationship to gold and silver, not always, sometimes it's more pronounced than others. That's why you could get an idea of what's going to happen with the paper price of gold and silver. And that's what it is, just to give you an idea of how it's going to fluctuate over the short term. And I knew we were going to see the sell-off in silver back about a month and a half ago. And I knew we were going to see the continued consolidation of gold. And I don't think we've seen the bottom in gold yet, and silver.
Interesting. So let's move to talking a little bit about futures contracts and why they're going to start running into trouble when we hit peak oil as well, Steve.
The futures contracts work when you have a stable future production and when you have a stable future economy and you have futures. And it could be copper futures, it could be milk futures. The problem with futures, they get into trouble when there's a problem with energy, because then you have a difficulty, and what's going to happen too, people are going to want the physical metal. And I don't disagree. There is manipulation in the markets. If the Fed can buy stocks, bonds, and they could buy stocks, bonds, and also mortgages, they're propping up the market. So there is a lot of manipulation in the market. But the problem is the futures are trading on so much. The difference between the futures is that when you buy a stock and a whole bunch of money comes in, the stock number doesn't increase. The stock float does not increase. So if a lot of money comes into it, the price goes up. With gold and silver, that does happen, but you can always add more contracts. So what it does is it kind of absorbs the upside potential. And I think that's one of the ways that futures for the metals now, for gold and silver, because they're more than just commodities, that's what the futures are doing. They're kind of absorbing the upside potential of the metal. And I think in time, the futures system won't work as well, and more people are going to want the metal. And I think we're going to see a lot smaller future contract. There's going to be a lot less metal. And so that's the future, to me, how things are going to unfold in the market as we move into this energy cliff.
Well, Steve, there's a million things here that we could continue talking about. I'll definitely have to have you back for a round two sometime. Let everybody know where they can find out more of your work and more of your writing.
Thanks, Tom. You can go to the SRSrocco.com. I put out some public articles, but I have gold and silver member articles. And I try to analyze the miners. I do mining stock analysis, and I do analysis on the oil industry. And I do technical analysis also on the energy, on gold and silver. And I think one of the things I wanted to mention really quickly is I look at these quarterly charts, Tom, that are more long dated, and I use a technical indicator to show where it's going to retest to. And so a lot of analysts are not looking at that. And I see where, if you look at these longer term charts, you can see a better indication of where these things are going to occur. And I tell you, I was looking at Bitcoin. Bitcoin was massively above on its quarterly chart, its technical indicator. And I knew it was going to correct. I didn't know it would be this quick, but at some point in time, Bitcoin is so far above this technical indicator that we're going to see the correction is not over. So I do appreciate your time. I think people need to look more at the energy, Tom, because the energy drives the economy. Mm-hmm. And I think we need to understand that better.
So Steve, to let's say hit that point really quick as well. That was another thing that was on my list to ask you, but I don't want to be too long-winded here. How do you look at Bitcoin from an energy standpoint? And how does it create, as some people say, have its intrinsic value when it is, let's say, is it necessarily a store of the energy that's going into it?
Actually, it is, because it takes a tremendous amount of energy to mine. And that's most of the cost is the energy, really. Mm-hmm. To do the mining, to produce the Bitcoin. The problem with Bitcoin is this. Did you see what happened yesterday? It fell $3,000 from 1950 to 1650 within a 24-hour period of time. That is not an asset that can be used as a currency. It's just too volatile. And another problem with Bitcoin is, and this is what I tried to tell people, that Bitcoin miners last about 2 years, maybe a little bit more. The banking servers that run the digital servers, the banking industry, they last about 4 years. And the dollar bill lasts about 8 years. But a gold coin will last at least 34 years. That's just the face gets worn off. You can remint it. The problem with Bitcoin, Bitcoin is a very high-tech currency, or let's say alternative cryptocurrency. And people say, well, if energy becomes problematic, I can still have my Bitcoin in an envelope. All right, that's fine.
How are you going to spend it?
The only way you could do a transaction with Bitcoin is you have to have a Bitcoin miner. You see, with gold, you could just walk into the store and say, okay, listen, I want this. Here's my silver coin. You don't need an intermediary. They say that Bitcoin is decentralized, but you always need a miner. You cannot give somebody a physical Bitcoin. It has to be done electronically. That's much different than precious metals. And that's fine right now when energy is not a problem. But when energy becomes a problem, Bitcoin is going to become in serious trouble because it's such a high-tech currency that needs a lot of energy to function. And unfortunately, people who believe in a high-tech future, they love Bitcoin. And unfortunately, I don't think we're heading to a high-tech future.
Yeah, it's a currency that takes not only energy to maintain, but also to transact with, right?
That's correct. And listen, people want to invest in Bitcoin. I'm not going to tell them not to. I look at things at more of a 5, 10, 15-year horizon because it's been almost 10 years now. Actually, it's been 11 years since the financial crisis. So what's the world going to look like in 10, 12 more years? People think we're going to be flying in cars like the Jetsons. I don't. I think we're heading more towards what happened to the Roman Empire. And people say, well, that's kind of depressing. Well, it happened. Matter of fact, all empires came and went. All civilizations collapsed. The thing is, either you understand it and figure out how we're going to deal with it, or you remain ignorant and then you deal with it in a chaotic, ignorant way. And I think it's just better to understand it and deal with it the best way we can. That's how I look at it.
Absolutely, Steve. I think that's a great place to wrap it up for this time. Again, you're available at SRSrocco.com and at SRSrocco Report on Twitter as well. Thanks very much for your time and your thoughts today, Steve.
Tom, thank you very much. I do appreciate your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.